A lot of the Canadian oil, for lack of a better term, is fairly similar.
Yeah. And nuclear is going to be a necessity to meet all this base load power needs that data centers are going to provide. We anticipate it.
There's a strange contradiction happening in the global economy right now. The world needs more energy than ever. AI data centers are exploding, electric vehicles are multiplying, entire industries are electrifying, and yet the stock market is treating energy like it barely matters. Today, energy makes up less than 3% of the S&P 500. That's down from nearly 30% in 1980. So why are some of the smartest investors on Earth, sovereign wealth funds, Brookfield, even Warren Buffett, quietly pouring tens of billions of dollars into the sector? What do they see that everyone else is missing? This is the story of the great disconnect in energy and why 2026 might be the turning point. Here's the paradox. Demand for energy is structurally rising, not temporarily, structurally. Massive data centers now consume electricity on a scale once reserved for cities. Some forecasts suggest U.S. data center power consumption could rise 50 to 200% by 2030. Then add electric vehicles, industrial electrification, emerging markets, population growth. Everything points in one direction. The world needs more electrons, more oil, more gas, more storage, more grid infrastructure. But after years of climate politics, volatile commodity cycles, and investor fatigue, public markets have pushed traditional energy to the sidelines. This creates what analysts are calling the great disconnect. Energy companies are still producing strong earnings, cash flows are still real, yet valuations remain historically depressed. And whenever markets misprice something this important, sophisticated capital notices. To understand where this is going, follow the money. Not retail traders, not hype cycles, the serious money. Sovereign wealth funds now control over $13 trillion. These are nation-scale investors with decades-long time horizons, and they're moving aggressively into energy. Norway's fund, the largest in the world, was built from oil wealth. Now it's using that wealth to buy offshore wind, solar parks, transmission assets, and increasingly, battery storage. This is not ideology, it's infrastructure logic. They want long-duration, inflation-linked cash flows from assets the world physically cannot function without. Then there's Brookfield. In late 2025, it closed a $20 billion transition fund, the largest private fund ever dedicated to clean energy infrastructure. They've already deployed capital into utility-scale solar, wind, storage, and power platforms across India, the US, and Europe. But here's what's interesting. They're not making a one-way bet on renewables. They're investing in what executives describe as an any and all energy strategy. That means solar, gas, storage, transmission, whatever delivers scalable, reliable power. Because in 2026, the real thesis isn't green versus fossil fuel, it's reliable energy versus shortage. Then there's Warren Buffett. When Buffett places a multi-decade bet, it usually means one thing. He sees durable cash flows the market is underestimating. By 2026, Berkshire Hathaway's combined exposure to energy has reached roughly $58 billion. That includes massive positions in Chevron and Occidental Petroleum, plus expanding ownership of Berkshire Hathaway Energy. And Berkshire Energy isn't just buying oil. It plans to spend more than $33 billion over the next 3 years on solar, transmission, and utility infrastructure. That's the Buffett formula. Buy assets with predictable demand, wide economic moats, and pricing power. Energy infrastructure checks every box. No matter what happens politically, economically, or technologically, societies still need power. The grid still needs to work. The lights still need to stay on. That's what Buffett is really buying. Not oil, not solar, dependence. But this is not a clean, easy investment story. Energy in 2026 may be attractive, but it is absolutely not low risk. There are 4 major fault lines. First, policy risk. Subsidies disappear, tax incentives get rewritten, tariffs change project economics overnight. A solar project that worked on Monday can become unviable by Friday. Second, geopolitical risk. Conflicts in the Middle East, sanctions on producers, instability in Venezuela or Iran, these events can instantly move oil, gas, and inflation expectations. And because energy touches everything, price shocks ripple into the entire market. Third, transition risk. An hydrocarbon asset with a 20-year payback period could become stranded if storage technology or regulation shifts faster than expected. And fourth, execution risk. Energy projects are huge. Delays, cost overruns, weak grids, and unreliable off-takers can destroy returns, especially in emerging markets. So yes, the upside may be real, but the sector punishes lazy capital. The bullish case really comes down to one word: underinvestment. For years, exploration budgets were cut, grid upgrades were delayed, transmission build-out lagged demand, utilities moved cautiously. Now the bill is arriving. Spare oil capacity is shrinking, natural gas demand is rising, battery storage is growing fast, and the grid needs a historic rebuild. This is how commodity and infrastructure supercycles begin, not with hype, but with years of neglect. When supply growth lags structural demand growth, the long-term marginal cost rises. That pushes cash flows higher for the companies and infrastructure already in place. This is why institutions aren't abandoning traditional energy, they're pairing it with transition assets. Oil majors for cash generation, utilities for stable returns, storage and renewables for secular growth. It's not ideological, it's portfolio architecture. The real story here is bigger than investing. Energy is becoming the central bottleneck of the next economic era. AI needs it, industry needs it, cities need it, climate transition needs it. And when something becomes this essential while remaining this unowned, it creates one of the most interesting setups in global markets. That's why the world's most patient capital is moving in now, not because energy is safe, but because it's unavoidable. The question isn't whether the world will need more energy, it's whether today's market prices fully understand just how much. And if they don't, 2026 may be remembered as the year the smart money saw the next energy cycle first.